Good afternoon, ladies and gentlemen, and a very warm welcome to the Mass Financial Services Limited Q1 FY23 post-results conference call hosted by Edelweiss Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jigar Jani from Edelweiss Wealth Research. Thank you, and over to you, sir.
Thank you, Rochelle, and good evening, everyone. On behalf of Edelweiss, I welcome you all to the Q1 FY23 earnings conference call of Mass Financial Services Limited. To discuss the results, we have with us from the management team Mr. Kamlesh Gandhi, Chairman and MD, Mrs. Darshana Pandya, Director and CEO, Mr. Ankit Jain, CFO, and other members of the senior management team. Without further delay, I would now hand over the call to the management for their opening comments, post which we can open the floor for Q&A session. Thank you very much, and over to you, sir.
Thank you, Jigar, and good evening to all of you. Happy to connect to all of you once again. And as you know that we published our result yesterday, and I think all of you must have gone through the results. At the outset, I would like to express satisfaction over what we have done in this last quarter, well in lines of our conviction, as shared with all of you from time to time, that we have very strong enablers to come back to a growth of anywhere between 20 to 25%. Having said that, the growth this quarter has been in excess of around 25% to 29% in AUM, corresponded by close to 26% in profitability. So this confirms our understanding and makes us more confident going forward that we have sufficient enablers and very strong enablers to continue with a growth of around 20 to 25%, what we have been doing since decades. I will give you the strategic heads up, and it will be followed by Darshan taking you through the numbers in brief, followed by Ankit talking to you on capital and liabilities. So just to give a heads up, as I told you that we are well back on the track of a very decent growth, what we have been doing over all these decades, which doubles our AUM every 3 to 4 years. And secondly, starting from capital and liabilities, very highly capitalized at around 25%. And liability management has been very strong. That has been our forte over all these years. We had sufficient liquidity, or we could reduce the liquidity because of the strong the strong pipeline and the confidence being the economy coming back to normal. So on capital and liabilities, we remained very strong with very strong capital adequacy. In terms of the product distribution, we continue to focus on MSME, where 90% of our business comes from micro, small and medium enterprises. And across the category, we have registered a good Y-on-Y growth, followed by contributions of two-wheelers and commercial vehicles. As I've always shared, that once we have a very normal, continuous economic growth, we will see that also contributing more going forward. In terms of distribution, we are, as I talked to you, in close to 6,000. Potentially, we can fund at close to 6,000 locations in the country, spread across our 6 states, and accompanied by our strong partnership with more than 150 NBFCs. As shared with you from time to time, our direct distribution is increasing, so the share of that in our AUM is also increasing. If you see, that share currently is close to 55% as compared to 45% last year, and this will gradually increase. While we hold nothing against our NBFC distribution that has performed exceedingly well, and just to translate into numbers, of 17,000 crores of a cumulative disbursement over a decade, and loss given default of less than 1% speaks of quality intermediation of all the partners we work with. But however, we are keen to increase and penetrate more in the states we work, and that will increase our direct distribution. In terms of asset quality, if you see, the asset quality has been maintained. And as you know how we work, we always prioritize asset profitability, and the priority is asset profitability and growth. Having said that, we have demonstrated our capabilities to grow continuously despite of prioritizing profitability and assets over growth. Our profitability and quality of assets over growth, the growth had been very robust over all these 2.5 decades. So asset quality remains strong with net NPAs at close to 1.63% of our stage 3 asset at 1.63% of our total AUM. So that speaks about our understanding of the sector and our niche expertise over all these years navigating through all this crisis. While the asset quality is strong as a conservative approach, we still continue to carry close to 0.62% of provisioning buffer currently, and that will be used over a period of time gradually. So that was on the asset quality. Coming to our housing finance, that has also started showing very positive signs of growth at around 16 to 17% of AUM growth this year, and we are very confident that on a low base we will be in a position to register at 25 to 30% growth on an year-to-year basis. So overall, it has been a very strong quarter. Customary mass fundamentals are the way we are working over all these years. We had expressed this conviction and confidence during all our interactions with various lenders and investors, and we are very happy to demonstrate our capabilities now, and we see no reason why we will not be in a position to continue going forward. So going forward, the things look very positive for us. It's very strong enablers, strong capital adequacy, and once again I would like to share this capital adequacy mainly through internal accruals. It will be close to 5 years since we raised our capital in IPO. So it has been a non-dilutive growth and mainly through internal accruals, which requires very high level of operational excellence, asset quality and profitability. That is what we have demonstrated over all these years. So with this background, I would like to, and with this confidence, I would like to hand it over to Dashraben to take you through the basic numbers, which should be helpful to you to understand the working better.
Thank you, sir. Good afternoon, everyone. I'm happy to connect once again with all of you. So I'll take you through briefly take you through the numbers. First, we'll take the MFSL, the parent company. So we started this year at 6,246 crore, and as on June, our AUM stands at 6,684 crore, and June 21 was at 5,162 crore, which is 29.49% growth in AUM. And the configuration of this AUM is around 89% is coming from micro loan, micro enterprise loan, and SME loans, and to wheels is around 11%. Now coming to the income numbers, total income grew by around 33.56% from 148 crore 50 lakhs to 198.33 lakhs. 198 crore. Profit before tax grew by 25.69% from 49 crore to 62 crore. Profit after tax, in accordance with the PBT, grew by 26.33%. That is from 36 crore 83 lakhs in Q1 22 to 46 crore 52 lakhs in Q1 23. Regarding the quality of the asset, as Kamlesh mentioned, we maintained the quality as on June. Our gross stage 3 asset is 2.28%, and net stage 3 asset is 2.27%, and net stage 3 asset is 1.63%, as compared to 2.28% and 1.7% as on March 22. And we continue to carry the provision by management overlay of around 34 crores, which is 0.62% of our total on-book assets. Now coming to our housing numbers. Asset under management of our housing portfolio is now 343 crores as compared to 294 crores 70 lakhs in June 21, which is 16.46% growth in AUM. Total PBT grew by 32.53%, from 1.1 crores 6 lakhs to 1 crore 41 lakhs. Profit after tax has increased by 29.86% from 82 lakhs to 1 crore 7 lakhs. Here also the quality of the asset is we could maintain that is gross stage 3 asset is 0.54% and net stage 3 asset is 0.38%. It was almost same in the last in March 22. Here also we continue to carry management overlay of around 3 crore, which is 1.06% of our total on-book assets. So this was regarding the performance of both the companies. Now I'll request Ankit to take you through the capital and liability management during the quarter.
Thank you, ma'am. Good afternoon to all. To further elaborate on capital liability management, we were able to maintain an equity buffer of around 600 crore on our average basis and an unutilized cash facility of around 400 crore. In addition, the company has sanction on hand to the tune of rupees 1,500 crore in the form of various instruments like term loan, DA and co-lending. In the last quarter, the company did around 300 crore direct assignment transaction. The company has further more than 1,000 crore sanction on hand, which we utilize during the current year. The company aims to maintain around 20-25% of AUM off book through direct assignment transaction. In the last quarter, we did around 40 crore of co-lending transaction with bank, and we are in process of tying up with various banks for co-lending, whereby it will be a win-win proposition for both the entities. Company has available cash facility of 1825 crore, out of which utilization level is around 60-70%, and rest portion is kept at liquidity buffer. We raised 616 crore term loan during the quarter. This has an average tenure of 3 to 5 years and help us to maintain the asset liability maturity better in a better way. Further, we have around 400 crore sanction on hand, which we utilize during the year. We have assessed our structural liquidity for the period, and based on the assessment, there is no negative impact on liquidity, and the cash flow in all cumulative buckets remain positive. As told, the capital equity remains strong at 25.28%, with Tier 1 capital of 22.49%, and a great scope to increase the Tier 2 capital going forward in order to have a healthy capital structure. The debt equity remains at 3.74 times. The cost of borrowing for the quarter has remained stable at 8.64%. In the current given increasing interest rate scenario, we envisage that cost of borrowing to remain stable with the increasing trend of anything between 25 to 50 bps. Thank you.
So thank you, Ankit. And before we open for Q&A, I'd just like to add on the digitization drive that we have taken at the company level. So what we are doing is that we are trying to digitize all our internal processes, which can accord more efficiencies, especially in origination and also into credit decisioning. So we have a strong team of 30 people plus in the department who are constantly working to digitize all the processes we have across products. Besides our tie-up with various fintechs, and we are tying up with fintechs in a way whereby the victim of extending credit where it is due is not diluted, and across our products, which gives us a better origination reach to the places where we might be missing in case despite of our best efforts. So I think we all know that we have to be more focused and absolutely aware of the technological advancement happening in the financial services space, and we are much aware of it, and the company is constantly in the loop, and will endeavor to see to that how we can use the technology in the most optimum manner so as to increase efficiencies. So that was on the digitization drive of the company and the tie-up with fintechs. So with this, I would like to open this session for the Q&A. We'll be happy to answer your queries. So that session may be open.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We would like to request participants to please limit their questions to 2 per participant so that the management can take questions from everyone. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Jehan Bada from Nirmal Bang. Please go ahead.
Yeah. Sir, congratulations for good numbers.
Sir, I'm sorry to interrupt. Are you on speakerphone? Could you please switch to a handset?
Yeah, I've switched to a handset.
Thank you.
Yeah. So, sir, congrats for good numbers. Sir, I have one question on fee and commission expenses, which is at 13 crores for the quarter. If I look at previous quarters, this number actually before COVID used to be negligible at around 1 crore or so. So, can you explain what this is?
The fees and commission expenditure is a part of the operational expenditure as we increase our distribution strength. If you see pre-COVID, we were at around 3,500 of our distribution in terms of centers reach, which has increased to now close to 6,000. And secondly, as said last quarter also, that with the partner NBFCs for better control, we have changed our working model from receiving the complete receipts from the customer and then sharing the IRR post receiving the complete amount with us, and then that amount is shared with them. So that is being parted as fees and commission to them. So this is a function of 2 things: the change in business model for better control with our NBFC partners, and also the increase in the operational expenditure because of the increased reach and increased retail business.
Okay, fine. Thank you, sir.
Thank you. Our next question is from the line of Amarnath Bhagat from Ministry of Finance, Oman. Please go ahead.
Yeah, hi sir, and thanks for giving this comfort to investors that you continue to maintain your same path of consistent growth and maintaining the capital adequacy. Now my first question is relating to this maintaining the higher capital adequacy much more than what the regulatory requirement is. How much is your negative cost of carry?
See, let me take you through that how this capital adequacy fundamentally has evolved over a period of time. While statutory requirement is 10% Tier 1 and overall 15% Tier 1, that is a bare minimum capital unit. As you know, this sector has passed through a lot of crises and a very continued crisis since 2018. So it is prudent to control the leverage and have more capital buffers, and with a view to safeguard the overall working of the company and to make it more fundamentally strong. We have internal plans to maintain it anywhere around 20%. This 25% is a function of a slow growth for 2 years during COVID time, whereby we continued to make profits during that period. So there was internal accruals not backed up by sufficient growth for at least 2 years, and that increased our capital base. And if you see it in a perspective, this capital base will give us a sufficient room to grow internal accruals only over a period of time. So this capital adequacy is a conscious decision. Keeping this capital adequacy is a conscious decision. Secondly, post this crisis, usually the leverage for NBFCs at around 5 or 5.5 was well acceptable by the lenders, which has changed gears to 3.5 to 4 times. So taking all these things into account, I think we have a capital adequacy which is sufficient to fuel our growth through internal accruals, and that is evident from the fact that even our return on capital employed is a healthy 15% plus. So it is not at the cost of the return on capital employed, but it is a conscious decision by the company to be well capitalized. And overall, as we come back to the normal trajectory of growth, we see it hovering around 20%.
Yes, sir. Well understood this point, and that is the history of your company as well, that to maintain a higher level of capital adequacy. The purpose I'm asking this question is, if our growth rate of AUM is 20-25%, the leverage is around 3.5, 3.7. The return on assets is supposed to grow little higher. One side, our expenditure profile, all expenditure profile is keep on increasing, and that is the income rate and the expenditure rate is not going line on line. Generally, it's supposed to be, if it is 25% on the AUM, around 20-25% should be on the bottom line as well. But if you see this bottom line increase because of whatever expenditure others is not in line with the growth profile of this company. And also the return on assets and return on equity both are more or less stagnant. Now we are almost 15 years, 25 years old company. You already have a growth base there. Why? I'm just trying to understand why we are not being little aggressive based on your experience and the depth you might have already been achieved in the market. And we are seeing it, the bottom line is really not been increasing in that way.
So, to answer your question, I think on bottom lines, if you see, and if you don't just take a quarter or two or a year or two, we already in our presentation that over 25 years, we have grown our PAT at the rate of 40%. And that well corresponds with the AUM growth. If you see a 25 years long journey, so I think I will draw our attention to that fact. And secondly, matching expenditure and profitability absolutely line to line might not be practically possible when you are in an expansion stage. It might lag few quarters. But even though we have endeavored and we have demonstrated our capabilities to be very close to that, as I shared with you that a 35-40% growth in AUM over all these years accompanied by a corresponding rise in profitability over an extended period of 20-25 years, which is demonstrated and which has seen lot of headwinds over all these years and various cycles. In terms of being aggressive in growth, being a practitioner, if I share with you, growth is not only the function of the capital and the debt. We being into informal funding, we being into retail funding, I think operational excellence plays a very important role. And even though when you talk about a 20-25% growth, that is doubling your AUM every 3 years. And over the years, we have seen that the common denominator for failures across the players has been exponential growth. It's not about lack of opportunity or lack of capabilities to raise more debt or more capital. It is about a cautious understanding that how you can manage growth. This growth has to be managed in such a manner that it adds value to all the stakeholders and generate a good ROAs and ROEs. Coming to ROAs, expansion of ROAs beyond a point is difficult if you want to create quality assets and if you really want to grow continuously at 20-25% because there are a lot of competitive forces. So expansion of ROAs, we have always seen that the value add what we do, 15-18% ROAs and a close to 3-3.25% of ROA is in sync with the value add we do to all the stakeholders. And this is what we have understood and we have zeroed down on this fundamental after a long understanding of 25 years of working.
So just to follow up a little bit, sir, only the same point. Just to follow up, ma'am, that so your guidance is 20-25% of the loan growth. So with the corresponding period of 5 years, what's your guidance on the ROA and ROE? This is my last one. For the same period, for the next 5 years.
While we cannot predict that, the visualization is that it will keep our ROAs anywhere in a range of 2.75 to 3.25%, translating into ROEs of anywhere between 15 to 18%.
Thank you, sir. Thank you very much.
Thank you. Before we take the next question, we'd like to remind participants that you may enter *1 to ask a question. Our next question is from the line of Madhu Chanda De from MC Pro. Please go ahead.
Yeah, hi, sir. Good, congratulations on very good set of numbers. I have one housekeeping question to start with, which is what is the disbursement figure for the quarter?
It is 2,153 crores.
Okay. So my next question is, we had seen, two rounds of rate hike by the central bank in the last quarter. But we have seen that you have seen a tad reduction in the cost of funds and some improvement in margin also. So if you could explain that and also give us some guidance on how you see your NIM behaving in a rising rate trajectory like now.
To start with the NIMs, what we intend to maintain and what we foresee is it will be maintained in the range of 6.75 to 7.25% if I talk range bound, and if I give a figure, it will be around 7%. In terms of what was the impact of the increased rate scenario, let me take you through how we borrow. Our borrowing is MCLR based, and this MCLR resets is usually around 6 months to a year time. So as soon as the repo rate increases, our borrowing rate does not correspond immediately. So that is the advantage what we get, that there will be various borrowings where there will be resets at various point of time. And presuming that these repo rates are going to be at a pre-COVID levels, we envisage, as Ankit told in his opening remarks, that we envisage a total rise in interest rate by anywhere between 0.25 to 0.4% on our borrowing. And as shared in the last con call, that we have around 70% of our assets whereby we have the possibility to increase the interest rates. So the passing on the interest rate in such scenarios where there is there are a lot of subsequent rise is possible. So we have 70% of assets like that. So combination of our borrowing and our capabilities to pass on the rate to an extent should see us maintaining the NIM stabilized. On the reduction in a slight reduction in the interest rate might be the function of the change in the borrowing patterns or the institutes through which we were borrowing. So it's not so that we have started borrowing at a quite lesser rate, or it might be a replacement of few type of credits with a different type of credit. Just to give you an example, we have 2,000 crores of CC limit, which is where around 60% is covered out as WCDL, and WCDL is benchmarked to a 90-day MCLR. So if the usage during the quarter in that portion is higher, will reflect a lower rate of interest. But on a margin basis, a mean basis, we expect this to hover around 7%, taking into account even the rate hikes.
Sir, if I may just ask one more question. If you could throw some light on what would be the rough breakup of your AUM between your own sourcing, the third-party NBFC sourcing, fintech, and co-lending?
I think our own sourcing is 55% versus all other combined at 45%.
I'm really keen on understanding how the fintech partnerships and the co-lending is picking up.
It is picking up gradually. Last quarter, we had a 200 crores of disbursement through fintech origination, whereby, as I shared in my opening remarks, that it is based on the credit screens what we give and the area of operations will be comfortable with. So basis that will entertain the leads from the fintech players, and that has been close to 300 crores this quarter as compared to 200 crores last quarter. And this is the space where we all are trying to understand and learn that nuances of the game in such a manner that in future we can use this very effectively and efficiently to originate the business without compromising with the quality of the credit.
And sir, your colleague mentioned 40 crore was the co-lending, right? What was the figure?
That is co-lending from the liability side.
That is on the liability side.
Okay, I'm so sorry. What was the co-lending on the asset side?
I think on co-lending on the asset side, included in those 45%, I think must be around close to 300 crores.
In the quarter gone by?
Yeah.
Okay, sir. And if you permit me, I'll just ask my very last question, which is, sir, you mentioned about this, your aspirations of a steady growth of 20-25% in this year, in the current fiscal. I mean, what are the challenges to this growth number? I mean, what do you see in the horizon which can upset this growth number?
As I see right now, interest rate is well covered. The probabilities of headwinds, what we see is the volatility in interest rates, that is well covered. In terms of the economy picking up, we see a very active movement among our borrowers for disbursements. So we see this market picking up, accompanied by our distribution increasing both through a direct reach and through NBFC reach, and a very huge market. So I think that 20-25% growth, we are very confident on that. And the only headwinds what we see right now, presuming that things remains as benign on the health ground the way it is right now, I think was the volatility in the interest rates, and that is well covered. Besides that, I don't see much headwinds for attaining this 20-25% growth.
Thank you, sir, and all the best for the year.
Thank you.
Thank you. Our next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity, and congratulations for a great set of numbers. I think past 2-3 quarters, growth is picking up on this.
Sorry to interrupt, but there's some disturbance from your line. Could you please adjust your...
Yeah, is it better now?
Yes, it is. Please go ahead.
Yeah. So, sir, congratulations on a good set of numbers. I think past 2-3 quarters we have seen pick up in our disbursements, and AUMs are growing as well. Sir, on our major segment which is SME, as well as on the microfinance side, we last 5-6 years we have seen quite a bit of disruption, starting from demonetization, GST 2019-20 also was a bit challenging in terms of growth, and then you had last 2 years of COVID. So almost 5-6 years of disturbances we have had. Year after year there has been tough times. Given given our expertise in the segment and our lending to this segment, do you think that this segment will now bounce back and we can see a decent growth of 2-3 years, barring some external disturbances or impact which can come? Apart from that, we are here for at least 2-3 years of normalized or a good growth in this segment now.
Definitely. When we talk about India growing at a healthy rate of 7% plus, these are the segments which are going to contribute predominantly. So we see a lot of scope, and we are very bullish going through not only for 2-3 years, but in more than that in the medium term. And secondly, as you very rightly remarked, this sector has gone through the most difficult times of our life. If we add COVID, that has been a very unprecedented times, what we have seen over all these years. And the enterprises who have survived all this are well geared up and are very enthusiastic to grow and cope up the lost ground of last few years. So all this combined should give us a good opportunity to partner in their growth, and providing and their growth means they will need more working capital. They will need more capital for capital expenditure, and that is where financial services will play a very important role, being catalyzed in their growth. So I would absolutely agree with you that this is the time, the next few years at least, not envisaging any other macro hiccups. I think this sector is going to exhibit a very strong and a decent growth, and a high quality growth. And we can, as a very strong player in this segment, I think, and a very old player in this segment, we will definitely tend to benefit from this. And that is where the confidence stems out, that to grow at the rate of around 20-25% even on an expanded base.
Sure, sir. And sir, the second question was on the liability side. We given our size and our rating has been largely been dependent on bank borrowings and the cash rate and term loan contributing more than 60-65% of our total borrowing. And our exposure to the capital market through NCDs as well as CPs has been pretty less, and we've just started exploring those options now. Do you think with hopefully improvement in rating to AA category with our size of AUM increasing over a year or two, our exposure to capital market will increase, and this might help us reducing our cost of borrowing by a certain extent, given the yields in those segments are relatively lower compared to bank borrowing?
Definitely. So if you see that we already have made a very healthy entry into capital market borrowings with close to around 700 crores outstanding in terms of NCD through capital market borrowing. So that is approximately 10% of our total liability. And we believe in a diversified liability profile, be it banks, private banks, and capital markets. And as the rating improves, as the size increases, definitely we'll get an advantage to tap the capital market at a more competitive rates. Currently, restricting capital market exposures is only because that we want to be competitive on the rates also. The rates offered by the other lenders are much more competitive than what we would go out to capital markets and borrow. And as we have seen that given our track record, given our capital adequacies and all, the institutional lending pipeline has always been so strong. Just to share with you, by August 15 or by August 30th, we will be having the tie-up for the complete year. And then we'll be scouting for better opportunities, lesser interest rates, a diversified source of fund, and so on and so forth. So as we grow, capital market exposures will increase, but we'll have an eye on the cost factor too.
Sure, sir. Sure. Wish you all the best, sir. Thank you.
Thank you very much. Our next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and thanks a lot for taking the question. Sir, I had three questions. One is, while talking about ROAs and ROEs, if we do have the sort of thinking about growing multifold from current levels over the medium term, so when you break up the ROA, are there any levers on OPEX as we scale, let's say we scale 4-5x from here, do we see OPEX coming down? The other is cost of borrowing, which will definitely happen, but do you intend to sort of keep a part of that benefit to you increasing your ROA? And third is, of course, the tech sort of efficiencies. So you spoke about some of the tech initiatives that you are taking. So do you see, part of them sort of helping you increase the ROA? So any of these three levers, do you envisage them working for you if you go at a very high scale? So that is question number one.
See, economies of scale always benefits. As we grow, economies of scale along with the use of technology will definitely benefit. But if you see right now, because of our distribution model, our OPEX is absolutely at the optimum level or at a very high efficient level. So once we start having more and more business through a direct distribution, the OPEX might increase, but it will not affect the ROA because ROA the yields will increase at a faster pace than what we will spend as expenditure acquiring that business. So as we grow, economies of scale, both in terms of operations using technology, increasing in yields as we go along, and secondly, definitely the decrease in interest rate because of the increase in ratings. See, this is, if I just take you to the fundamental, lending is a business of arbitrage. So as and when we grow and our rating also increases, so what will happen is that we'll be at the higher strata, and we will be in a position to explore that to the advantage of increasing the ROAs marginally. But having said that, as we grow, we will also have to enter few of the segments whereby those segments will be little competitive as compared to what we are working. So over a period of time, we are talking about growing 3-4x. So we talk about at a 25,000 crores AUM. What we envisage is that there will be a lot of dynamic changes happening, and ultimately we have seen and what we visualize that ROAs will settle in a range-bound manner between 3 to 3.5%, and given a decent leverage and de-risking will result into anywhere between 16 to 18% ROEs.
Okay. And what is missing on the tree is also the fee income. So do you envisage that as you scale up, are there any potential thoughts on, generating non-lending sort of an income to sort of help that ROA? Are you seeing that as you scale that, that can be a possibility?
Yes. So we are in process of getting the insurance license, while we already do insurance business, which is a natural service to our lenders to whom we lend, along with the open market operations. So this is one business which will align with our line of activities. And secondly, we will also explore other fee-based avenues whereby we can generate fees working with our own SME clients as we grow. How we can mobilize capital for them, or how we can be of other services to them, that will definitely be explored. So currently the idea is to first build up scales, and then once we build up scale, foray into various activities whereby we can generate fee-based income. So just an example, we are almost due to get the broking license within, say, next quarter or two, and that should help us increase our fee-based income.
Understood. Now coming to the housing business, sir, it's been there for a while. We have already showcased a very low NPA numbers on that book. But you would also agree that the book is so small that those NPA numbers do not sort of hint or tell us how it will behave at a scale. And book being so small, it hasn't really contributed at all towards the overall growth also. So what is the thought process, sir? I mean, there is no sort of a meaningful contribution from that business to our business. It's been there at a very good profile, but then the scale is really low. So do we really want to do something there? And when will because at that scale, 17-16% of growth is meaningless. It's such a small scale. So do you see, that book growing at 50, 100% or plus, or do we have any different way of looking at that business to scale it up, or it will continue to be in the shadows?
So that will start contributing very meaningfully, and we see a 3 year horizon whereby it will start contributing, where this book will grow at the rate of 30 to 35%. And just on the housing finance, I am not in judgment of how various players operate, but we have seen this informal housing finance so closely. There are 2-3 things where we differentiate. When we talk about housing, is a majority pure play housing and not a bulk of lap into it, number one. Number second, the quality. Definitely you cannot extrapolate on a bigger number, but at least you can get the direction of the working of the company and the fundamentals of the company. Because if the direction is not correct, even on a smaller base, it is on the contrary difficult to maintain a high quality of assets because you don't get the denominator advantage. So taking all this thing into account, we are very confident that the things are stabilized, whereby the housing finance market has been differentiated into various interest rate cohorts, right? Starting from 7 to 9% to 15 to 17%. We have placed ourselves anywhere between a 10 to 12% interest cohort where we see a lot of traction. It was a very cautious decision by the company to grow it cautiously over all these years. And now we will slowly, 16-17% is a journey. Overall, it will start from this year. We see, I am very confident of overall 30% growth as compared to the last year. And once within next 2 years or 3 years, once we reach 1,000 crore mark, and then also we continue with a growth of around 25 to 30%, we'll start contributing very meaningfully. And our medium term view is that this is going to contribute, not substantially, but it will contribute very decently.
Understood. On your NPS.
I'm sorry to interrupt.
Yeah, sure.
I request you to please return to the queue. There are other participants. Thank you. Next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. And sir, congratulations on a very good set of numbers. So, sir, first question with regards to our micro enterprises loans. Typically, in last few quarters, our average ticket size used to be around 45,000, and gradually it had come down in the last 3 quarters to around 24,000, from somewhere in the average of 45,000. And in this quarter itself, we are seeing a jump from about 25,000 to 46,000. The average ticket size has gone up. Anything to read into this, or is this some reclassification being done? How do we read this?
I think the ticket size were lower in previous quarters, mainly because we were in during the COVID or coming out of COVID. So during that time, the per person, per individual exposures were restricted. And once we saw the things coming back to the normal, that is, we have come back to the original exposures. And if I tell you the direction, anything less than 3 lakhs of rupees will be a micro enterprise loan. So there will be a conscious efforts by the company to increase the ticket size with the deserving borrowers, because we like to grow with the borrowers, and now things being stabilized will give us the confidence to increase the ticket size there also. So there we understand that the ticket size will gradually increase. But once again, not at the cost of or compromising the quality of the assets.
So is there a change in the kind of borrowers whom we are lending, in terms of, typically certain borrowers to whom we were not lending, and now we have started the lending back, or is it a different kind of borrower, or is it more due to also higher disbursements happening to the fintech? Anything on those lines?
I think that we sold to more than 300 different categories of borrowers, and more or less we revolve around those category of borrowers only. So as I told you, the ticket size is a matter of the comfort that we draw from time to time basis the macro conditions in the economy. So if we are comfortable and if the things are going smooth, and as you know that we have stabilized, we are in the process of stabilizing from last Q3 onwards. So now we are getting the confidence to cater to the demand the way the borrowers would like to borrow from us. Normally what it happens that he wants a lakh of rupees, but we will contribute around 30,000, 40,000, 20,000, whatever the internal guidelines are from time to time. So the borrowers remains the same, and fintech or direct disbursement, our criteria for extending the loans does not change. That if we meet certain criteria, if it is direct origination or origination through fintech, physical origination or origination through fintech, that does not change.
So with regards to our branches, one observation is key. We have done very well in terms of expanding our branches in the state of Madhya Pradesh. From about 10 branches about a year ago, we are today at 31. In previous interactions, you have mentioned that Maharashtra, Rajasthan, and MP. These are your 3 focus areas to take the branch network from about 125 to 250 next 3 years. So MP, you have increased it from 10 to 30, 31, whereas on Maharashtra, typically in last 3-4 quarters, it has remained in this band, or it has just gone up from 21 to 26. So is it like there is some conscious effort going on in MP where you feel you are much better off in terms of the resources or the branch network or the kind of reach you have got in MP? Just to understand, and going ahead, how do you see this?
See, opening of the branches depends upon our internal survey of those region and also getting the right sort of human resources. If we compare Maharashtra and MP, Maharashtra was slow deliberately because we all know that Maharashtra was highest hit during COVID. So we were waiting for a while before we can really increase the number of branches there. So we're trying to capture areas where we are more comfortable from credit risk as per our assessment, and also getting the resources what we need. So there will be a different numbers in different states from a quarter to quarter basis. It will depend upon the opportunity we get and how well we have executed in a particular state. So depending upon execution and the opportunity we get, it will differ. But overall, as I shared earlier, we intend to have around 250 branches among our area of operations. Maybe one state might be ahead than the other for a quarter or two. But once we get the right opportunity, I think it will be as per the overall planning.
Sure. Thank you so much, sir. Thank you, and wish you all the best.
Thank you.
Thank you. Our next question is from the line of Deepak Sonavane from Haitong Securities. Please go ahead.
Yeah, good evening, sir, and thank you for the opportunity. So I have two questions. First is on fintech. So we have seen a very strong growth in disbursements through fintech channels. So what has been our average ticket size for the disbursements through fintech?
I think we have around 300 crores of disbursement done this quarter, and we see the average ticket size depending upon the product. If it is an annual loan, then the average ticket size will be around between 50 to 60,000 rupees, and if it is an SME loan, the average ticket size will be in the range of around 4 to 5 lakhs of rupees.
All right. And so my second question is kind of a data keeping. So can you just give out specific asset numbers for or listen percentage for all the four main categories, I mean MEL, SME, two-wheelers, and commercial vehicles?
So in terms of percentage?
Yeah, that will work.
Thanks.
Page 3. Yeah. Just a minute. So in two-wheeler it is 2.58%. SIPO is 2.35%. MEL is 1.53 and SME is 1.48.
Okay. Thank you, ma'am.
Thank you very much. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to the management team for closing comments.
So thank you, everybody. And for the ones who have missed out on this Q&A session, I request them to contact Ankit Jain or Nina Solanki, who represents us from the IR, and we'll be happy to answer all your queries. So thank you so much. And once again, as I shared in the opening remarks, we are very confident that we'll be in a position to achieve the growth what we have done over all these years and having very strong enablers. I wish you all the best. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Edelweiss Broking Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.